Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. Today is a big episode. I really wanted to give us all a break tomorrow, but once again there is just too much to cover. So today will be an economic focused video, and tomorrow we will move on to foreign policy. In the second half of today's video we will also cover a development which I am personally quite surprised by. It's a very cold weekend in China, especially northern China. Even the capital, Beijing, is buckling under the icy winter weather. This week, thousands of flights were suspended due to snowstorms. Then on Thursday, an icy storm led to a rear-end collision between two Beijing subway trains, sending more than 500 passengers to the hospital, including more than 100 suffering broken bones. Fortunately, no deaths were reported by the authorities. For those viewers in the Northern Hemisphere, I hope you're keeping warm this weekend. Let's begin with an examination of a slew of poor official data published yesterday, Friday. While some analysts do not put high trust in official numbers, the fact that official data trend is negative in of itself is quite telling. For our purposes, we still need to move through these data and take note of what prominent analysts are saying on them. China's economic recovery showed signs of losing further momentum as investment in customer spending expanded slower than expected in November last month, and this expansion was due to the zero-COVID base effect from last year. Retail sales, a key metric for domestic consumption, rose 10.1% in November from a year earlier, missing the 12.9% expansion expected by economists in surveys with Bloomberg, Reuters, and the Wall Street Journal. Larry Hu, head of China economics at Macquarie Group Limited, expressed on the numbers, quote, "Discounting the base effect, it's obvious that China's economy slowed further in November, especially in terms of retail sales and property." End quote. He added that retail sales actually fell 1.9% last month from October on a sequential basis according to his own calculations, that compared to double-digit year-on-year growth in the official data. Similarly, S&P Global Ratings estimated growth in retail sales, industrial output, and fixed asset investment all weakened across the board in November from a month before, when compared to 2019 levels, which US-based Bloomberg has visualized here for us. The chief economist for Asia-Pacific at S&P Global Ratings, speaking to the outlet, observed, quote, "It's very hard to see the economy growing significantly or people's confidence improving significantly. More needs to be done, apparently, just looking at how dire the situation is." End quote. The official surveyed urban unemployment rate remained at 5% in November, though this metric has become so acutely sensitive, politically speaking, that it's now in the realm of being too unreliable, especially since Beijing stopped publishing the official youth unemployment rate. The last time we saw this measure, it was over 1 in 5 young people unemployed. Industrial output was the only decent metric, a rare bright spot in the data, growing at a moderate 6.6% in November, the strongest growth since September 2022. Meanwhile, China's prolonged property downturn showed no signs of abating, as new home prices in key cities fell at a faster clip in November. Investment in property development has plunged 9.4% so far this year, according to official government figures. Indeed, the same day, yesterday, Friday, the National Bureau of Statistics also published official numbers on the property sector, and it wasn't pretty. A record number of Chinese cities saw home prices tumble in November, with new home prices in 70 major cities falling by 0.4% month on month. Prices of pre-owned homes dropped 0.8%, the most since October 2014. Average home prices generally thus fell 0.7% in November year on year, versus a 0.58% decline in October, again suggesting that the home price decline is deepening. 59 of the 70 cities covered by the data recorded falling prices for new homes in November, 2 more than in October. Only 9 cities reported growth in new home prices last month, 2 fewer than the previous month. According to Chinese financial media outlet Caixin's calculation based on the official data, both the average price drop and number of cities logging lower prices reached 9-year highs. The outlet, reporting on the data, observed, quote, China's housing market downturn has persisted for more than 2 years, with both prices and sales falling. Weakening market fundamentals have further dragged down the liquidity of the country's developers, most of whom are already trapped in a debt crisis. End quote. Dan Wang, chief economist at Hang Seng Bank China, expressed on the real estate numbers, quote, "Transactions are typically depressed towards the end of the year, and the property sector in general does not want to take on more leverage, and home prices are still too high compared to urban incomes. People will just wait out this downward spiral." End quote. Robert Cannell, regional head of research at Asia Pacific at ING, had similar thoughts, expressing, quote, "Anything vaguely related to real estate, property investment, real estate sales, fixed asset investment went backwards. China's recovery is ongoing, but it still looks narrowly based and vulnerable to any further worsening in the real estate sector." End quote. Home sales in the first 11 months of this year decreased 8% from the same period last year, and total sales value decreased 5.2% year-on-year to 10.5 trillion yuan, $1.5 trillion US. If we can take a brief detour and drill down on the property sector, in a report published last week by Oxford Economics, the UK-based economic advisory firm writes that China has a big problem within the real estate sector, you don't say, that will take at least 4 to 6 years to resolve, writing, quote, "However one slices the data, the existing excess supply in the market is likely to take at least another 4 years to unwind, increasing supply coming from secondary market transactions as households worried about depleting profits from price declines sell their second or third homes is an additional drag to this process. Developers' inventory is far too large for households to absorb quickly." End quote. We remember Nomura last month estimated the size of unfinished pre-sold homes in China is about 20 times the size of property developer Country Garden as at the end of 2022, at around 20 million units, and warned, quote, "At some point next year, the issue of home delivery could turn into a social issue and endanger social stability, and Beijing may eventually need to significantly ramp up policy support." End quote. It's estimated that over $1 trillion is needed to fill this hole. Oxford Economics lead economist Louise Liu, in an email to US media, warned that at the extreme end, quote, "residential construction in the relatively poor province of Guizhou could take well over 20 years to complete." End quote. Now returning to the general November data. Bruce Pang, chief China economist at Jones Lang LaSalle, speaking on all this new data published yesterday, expressed, quote, "The data shows a flurry of supportive measures that has not yet been successfully translated into near-term growth due to weak business confidence." End quote. In a sign that Beijing is still very concerned about its fragile recovery, on Friday, the same day, the People's Bank of China made the biggest net injection of cash via a one-year policy tool on record, 800 billion yuan, $112 billion worth of funds, sending a more powerful stimulus measure to investors after piecemeal approaches had left them disappointed. Zhong Lianghan, investment strategist at Standard Chartered Bank, observed on the move, quote, "It's too early to call it a turning point given that investor sentiment remains fragile and geopolitical tensions remain a potential source of risk." End quote. In a note published by Xing Zhaopeng, a senior strategist at ANZ Bank, observed that the November numbers are enough to ensure China meets its official target this year, but adds, quote, "Now the biggest question to the market will be next year's growth target, which will be disclosed in March." End quote. For next year, many economists expect China to announce an official growth target of around 5%. Thus, the focus is now on how Beijing plans to boost growth in 2024 in an environment of surging debt, high fiscal deficits, and growing concern for financial systemic risk. With these concerns, some don't think 5% growth, even when fueled by yet more debt, is even possible. For example, Tao Wang, chief China economist at UBS, expects it will be very challenging for China to achieve such growth and expects China's gross domestic product growth to slow to 4.4% next year. This week too, the World Bank cut its own growth forecast for China to 4.5%, citing significant risks related to the real estate sector, global demand, geopolitical pressures, high debt, an aging population, and structural headwinds. None of this, of course, is new to regular China Update viewers. Next up, we discuss the role of propaganda and the economy. Today's video took a lot of work to put together. It was a big job, but it's a pleasure to be able to present these videos to all of you and have them open and available to anyone for free 6 days a week. If you believe this video was worth putting up, if it added some value, if you enjoyed it, all I ask is that you please like and, for regular viewers, subscribe. This just takes 2 clicks of the mouse, but it's a huge help for me and for the channel. If you can share this video with someone you know, that would also be amazing. It is the only way this channel can grow and be shown to new people. And for those who want to keep the channel financially sustainable, I'm happy doing the work and releasing these for free. And I want this channel to be primarily subscriber supported, not reliant on corporate sponsorship, then Patreon and Buy Me a Coffee links are in the description below, and this is also an amazing help. Thank you so much, everybody, for the ongoing support. Next up, we remember last Friday, I believe, the Party Politburo in a meeting to, quote, analyze and study the economic work for 2024, end quote, announced that, quote, it is necessary to enhance the consistency of macroeconomic policy orientation and strengthen economic propaganda and public opinion guidance, end quote. It appears that this strengthening economic propaganda and public opinion guidance work is already well underway. Today, US outlet Bloomberg reports that Chinese microblogging site Weibo Corp is asking some of its users not to post negative content about the economy. Quote, a move that underscores concerns about spluttering domestic growth. End quote. The outlet writes that the social media service, which is often compared to X or Twitter, sent notices to users warning them to, quote, avoid expressing pessimism about the economy. End quote. One Weibo user, which is focused on finance, quote, said in a Thursday night post that they were previously told to post less about the economy and instead shared a light-hearted video about US baseball, end quote. Another Chinese markets blogger, quote, posted a separate notice asking bloggers to avoid crossing the red lines, particularly around economic or financial topics, end quote. Then on Friday, yesterday, China's Ministry of State Security, the country's principal civilian intelligence, security, and secret police agency, said that it would fight back against a, quote, narrative war, end quote, over its economic condition, signaling, incredibly, that discussion of China's economy is now a national security matter. The ministry said in an official statement online, quote, talk concerning China's decline is, in essence, an intention to create a narrative trap or a cognitive distortion. It aims to doubt or deny China's socialist system and attempts to strategically contain China's development. There are some people with ulterior motives. They are fabricating a China threat again with the intention to disrupt market expectations and economic growth momentum. End quote. One unnamed Shanghai-based scholar speaking to Hong Kong-based South China Morning Post expressed on this development, quote, the National Security Ministry must echo the top leadership's mandate, and we know the backdrop of intensifying rivalry with America. We still wonder if normal discussions about the problems of the economy will inevitably cross the vague red line, now that Beijing clearly wants us to focus on the bright prospects, end quote. The fact that the Ministry of State Security has expanded national security to this wide scope is an incredible development. I am personally quite surprised by this. The State Intelligence Agency and secret police are now pushing economic policy. This is very much Mao-era stuff. It's important that we examine some of the key points made in this Friday statement in their own words. The post is called, National Security Organs are resolutely building a solid economic security barrier, and we are now quoting selected excerpts from this piece directly. In his important speech, General Secretary Xi Jinping stressed the need to adhere to high-quality development and high-level security, fostering a positive interaction between the two. This reflects China's strategic approach to intertwining economic growth with national security. Economic security is a crucial component of national security, providing strong support for the safety of other important areas. Prioritizing the control of major risks and challenges is key to protecting the nation's fundamental interests. In the current era, economic domains increasingly become critical battlegrounds in global competition. Various cliques intending to talk down China's economy keep emerging. However, the truth is self-evident, and rumors collapse under their own weight. Development and security are two wings of the same body, the dual wheels of propulsion. Promoting high-quality development must go hand in hand with ensuring high-level security. Some with ulterior motives ignore this basic logic, selectively overlooking the global economic trauma and adverse impacts brought by 3 years of the pandemic and regional geopolitical conflicts. They ignore the strong resistance formed by the West's continuous decoupling and supply chain disruption against China, and in a wolf-crying wolf manner, maliciously fabricate narratives about us replacing development with security, squeezing out foreign capital, suppressing private enterprises, and other false narratives. They rehash the old tune of the China threat, deliberately cheating, provoking, and exaggerating the so-called irreconcilable contradictions between security and development. Their real purpose is to disrupt market expectations and order, and to block the positive momentum of our country's economy. Here ends the direct quote. The implications of this development are significant. Quote, "It can already be challenging to trust information from PRC sources, but now how can anyone take seriously PRC commentary or analysis or data on the economy going forward? How much harder will it get to do independent due diligence and research inside the country? How will the dynamic balance and mutual reinforcement between development and security and increasing censorship and discourse control mesh with the coming global launch of the Invest in China brand?" End quote. It is this minefield into which we venture as we continue to follow China into 2024. But here on China Update, I will make sure that we try to have the most accurate understanding of what's going on despite this narrative minefield. I hope you will come along for the ride and that the channel will grow with new people joining too. That is today's episode of China Update. Thank you so much everybody for watching. There will likely be an extra episode tomorrow on foreign policy. Have a good Saturday and I'll see you all tomorrow.